We've had some mixed readings with the latest economic data, which has left gold looking for the next direction. So let's take a look at how gold has been performing and what to expect in the next few days. Hello and welcome back to our channel. My name is Daniela Hawthorne. And in today's video, we are going to be looking at gold, as we know, one of the most traded commodities and also one of the most requested for our videos and traded on our platform. So before we get into it, please like this video, comment if you have any suggestions or questions, subscribe to our channel, and don't forget to turn on those notifications to get those alerts. Now, as I was saying, some mixed data with markets recently, which has left gold trading a little bit with an indecision pattern. The most notable data that we've had as of late is on Friday. We saw the unemployment data in the US, or more likely the employment data. We saw the likes of the NFP, the unemployment, the participation rate, also the wage growth data, and that has left gold seeking a little bit of sideways consolidation as traders try to determine where to go from here. Now, with regards to the data, we have actually seen the unemployment rate tick up in August, which has shown that the labor market is cooling in the US. We've seen the unemployment rate rise to 3.8%. This is actually the highest level that we've seen since March 2022. So, of course, that reading alongside the fact that average hourly earnings, which measures the change in wages in the US, the growth in wages, has actually come down more than expected. Markets were expecting it to remain unchanged at 4.4%. We have seen it come down to 4.3% on the yearly basis. So that drop also going hand in hand with the rise in unemployment, showing that the labor market in the US is in fact cooling. Now, with the data release, we also had the NFP data. The NFP actually coming in higher than expected, 187,000 jobs added in August, more than the 170,000 expected. But we have seen a downward revision to the figure in July. Now, something else to note with this release is the participation rate. It has risen, I believe, for the first time since February this year. It's now up to 62.8% compared to 62.6%, which is where traders were expecting it to remain. Now, the reaction in the market, initially we saw the reaction focusing on the fact that the unemployment rate had risen and average hourly earnings, which directly impact domestic inflation, had dropped. These two numbers in isolation, as I said, are giving the picture that the US labor market is cooling and therefore reduces the need to see tighter financial conditions from the Federal Reserve, reduces the need for further rate hikes, and in fact, even potentially deems necessary to see some rate cuts at some point throughout 2024. That picture, of course, giving a boost to the US stock market. We saw the dollar down. We saw US yields also reacting on that. Gold and silver picking up some bullish momentum on the back of it. So the initial reaction was positive for risk sentiment, as I said, focusing mostly on the fact that with unemployment ticking up and average hourly earnings coming down, then essentially it's a step in the right direction. Now, the way the market ended the day was very different. We definitely saw a change in rhetoric throughout the session, and we actually saw stocks being weighed on. We saw the dollar picking up some momentum, gold ending towards the end, the lower end of the range for the session on Friday. Now, it's likely that traders then started to digest a little bit more of this information, and they actually focused on the fact that first of all, that the actual NFP data was higher, so better than expected, but also looking at the participation rate and the fact that the participation rate rises, there is more labor force in the economy that will naturally put downside pressure on wages and therefore may justify that drop in average hourly earnings. So potentially reading into the fact that, okay, maybe these numbers look worse than expected because we have a greater pool of people that we are measuring, and therefore essentially it may not be showing a real picture as we thought. In fact, it actually gives the reasoning that the labor market is actually rebalancing itself in a good way. And it actually alludes to the fact that we are, in fact, potentially seeing a soft landing where the economy is managing to sustain itself whilst inflation comes down. That is the best case scenario for the Fed. That is the best case scenario for the economy. But of course, it weighs on that safe haven appeal that gold and silver have. So essentially, it seems like the rhetoric changed throughout the session. And that's why we saw some of this risk appetite dying down towards the end of the session. Of course, the fact that the Fed is keeping the talk about further rate hikes alive in itself puts pressure on real rates in itself, regardless of whether we see any further rate hikes or not. But it seems pretty clear now to markets that we're not going to see another rate hike in September. The question is, what is going to happen from there on out? Are we going to see peak rates remain at the current rate, or are we going to see them change? And of course, that is what's going to bring the most volatility to markets in the coming weeks. But for now, as I said, the data giving a little bit of a mixed reading. There's so many different ways you can view this. I think markets are still pretty much unsure as to how exactly the Fed is going to view this and how this latest unemployment reading is going to affect its policy decisions. Of course, we know it's a mistake to focus on one single month of data to make a decision. So of course, we'll have to see how this evolves further. We'll have to see how inflation evolves as well, because we know it ticked up in July after seeing a drop in June. So of course, what's going to happen to the CPI in August? That of course is all going to play a crucial part into the decision. But for now, it looks like the labor market is actually showing resilience despite seeing that cooling in conditions. And that leaves some safe haven assets like gold struggling to find a clear direction, despite actually seeing a little bit of support from the fact that we do still have concerns about a recession in China. We're getting a lot of mixed data from there as well. A lot of data suggesting the economy has cooled more than expected. We haven't seen that post-pandemic rush that everyone was expecting, and that of course appealing to some of that demand in gold. Let's jump onto the chart now to see how it's been trading over the last few days. Okay, so looking at the gold chart, Capital.com via trading view, as you can see here on Friday, this candlestick here, you can really see that clear indecision looking to push higher throughout the session. You can see by this longer upside body here, but ending the session pretty much unchanged, as you can see, as we saw that picture evolve, that initial reaction, seeing some risk on appetite, seeing the need for less tightening from the Federal Reserve, pushing gold higher alongside the US stocks and some of those FX pairs. But then coming to end the session, as I said, pretty much unchanged, showing that clear pattern that there is a lack of direction now. Ever since the end of this push here at the end of August, as you can see, seeing that sideways consolidation, lacking the momentum to actually break above those highs. In fact, we've seen lower highs throughout the pattern. Friday was the exception to that, but looking as to how the candlestick ended, showing that there is still appetite for buyers to come in. There is still appetite to push gold higher. But I think traders need a little bit more insight as to what's going to happen with the Fed policy at the moment. As I said, the data on Friday giving mixed signals. You can view it in different ways. You can take the data and see how it compares to other readings or how it compares to past readings. And you can kind of take a few different conclusions from that. One of them, and the one that seems to be the strongest at the moment, is the fact that we do have a soft landing, and that the Fed pivot may be close, but not quite here in terms of the way the Federal Reserve is going to be handling monetary policy. Expected to have Powell still talking about potential further rates, even if he isn't delivering them immediately. And of course, that leads to those expectations of no hike in September, but potentially one towards the end of the year. That, of course, will weigh on gold. As we know, gold is a non-yielding asset. As we see yields picking up, that weighs on gold. Expect to see US yields picking up if rates continue to rise. So expect to see a little bit of downside bias there. If we do see that rhetoric playing out even further and that taking dominance. Now, in terms of the RSI, you can see here trending higher towards the end of August, sitting around that 60 mark. We still have further to go before it looks like a clear pattern of overbought. As you can see, the sideways consolidation we've seen over the last few sessions helping to stabilize that, looking for a potential to break even higher. So path of least resistance could continue to be to the upside here in the short term. We'll have to clear this immediate resistance here at the 100-day simple moving average, currently at 1,953. Once that is cleared, looking to retest those highs that we saw back here in July, but also earlier this year in June and May. Just around that 1,975 area, that's a key psychological area, but also heading up towards that 9,090, which is also a key area where we've seen a lot of resistance coming in. As I said, fundamentally, lacking the momentum to really push higher at the moment. One of the things that really helps gold is fears about recession. Gold is a great hedge against recession. That hasn't really quite settled in yet. As I said, from China, we do have those fears trickling over. So we have seen a little bit of support coming in from there. But in terms of Europe and the US, we haven't exactly yet seen those fears consolidate even further like they did at the end of last year. So until we see that playing out, and until we see markets convinced that central banks are handling it in the best way they can, and that inflation is actually no longer going to be a sticking point, at least in the US, it's a different picture in Europe and especially in the UK. But for now, it looks like in the US, we may see a soft landing. Of course, that has been weighing on gold and likely to keep a lid on the gains for the foreseeable future. That is it for today's analysis on gold. Thank you so much for watching, and don't forget to subscribe to our channel.